Welcome to NavTalk Series 3. I'm Simon Prowse, your host. NavTalk is a podcast where we discuss a broad range of topics which will be inspirational and at times fun. NavTalk, brought to you by the Navwealth Financial Group, helping you reach your destination in life on purpose.
Welcome to this edition of NavTalk. Today we have a fantastic lineup of speakers for you talking about the world of investment. And our first speaker and special guest is Brad Matthews, who chairs our investment committee at Navwealth. Welcome, Brad.
Hi, Greg.
Thanks for being here. And I've also got Alistair Metham from Navwealth, who's also joining our talk today. And today's talk is going to be all about investment strategies and investing. And I think it's a really great time to be having this discussion, given the headwinds that we have coming towards us. But before we start all, I might just give a bit of an update, Brad, from what I've got here, and you can add something at the end. So nearly 40 years of experience in the financial industry as an economist, Brad. That's a long time. You don't look anything like you're old enough to have had 40 years experience. I think what interests me is in your early career, you spent time in banks, in economist-style roles, and I met you many years ago. In fact, I was surprised when I was reminded that you've been in your business now, and a consultancy business, for nearly 10 years, advising firms like Navwealth on investment committees. And because when I met you, it was way back when you were at AMP, and you spent 12 years there, I think, as head of research and head of investment strategy, helping financial advice firms like Navwealth. So Brad and I go back a long way, and you've been now with Navwealth. I didn't look this up. How long do you think you've been with us?
Look, I think it's probably 8 years, 8 or 9 years.
Yeah. So we've had Brad on our investment committee now for 8 or 9 years. So talking about that, Brad, how would we help our listeners understand what you do for our clients at Navwealth in terms of your role on our investment committee?
I think the first thing around my role is to understand the philosophy when it comes to investing of Navwealth. So what are you trying to achieve for your clients? What are some of your investment beliefs around how portfolio should be constructed, and helping you articulate that and getting an understanding, or maybe a deeper understanding, of what the investment strategy should be. And once we know what that philosophy is, it's about building core portfolios that really reflect that. And that's both from an asset allocation perspective, but also in terms of assisting Navwealth select individual funds that make up the portfolio. So a big part of my role is to assist with the selection of the actual investments, because there are just so many investments out in the marketplace that any individual financial planner doesn't really have the capacity to review them. So part of my role is to do that work, bring it back to the committee, and make recommendations about product selection, and those products may then find their way into client portfolios.
Yeah, and that's what I see, Brad. We don't have time to, there's tens of thousands of funds out there and investment vehicles. We don't have the time to spend enormous efforts on researching those particular options. And by you coming along to our investment committee means we have robust discussions of what kind of blend of portfolios we put together and what is our philosophy. And I think it gives Navwealth a real sort of independent view of what we're doing for our clients. And it ends up being that us advisors don't just believe each other and end up having no investment philosophy, which is often what I see out in the marketplace. I think, Brad, you keep us tight on what is our investment philosophy and what are we trying to do for our clients. And Brad, something I didn't know until a few years ago was your Plain English Economics newsletter. Tell us about that.
So this is a economics newsletter I've been doing now for over 30 years. So it's for high school students. So it's designed to bridge the gap between the theory and what's happening today in the world of economics. So most of the schools who study economics around Australia subscribe to the newsletter, and they've been doing it for 30 years, so I must be doing something right there. But it's certainly made sure that I've been up to date with what's happening in the economy, because I have to write a new newsletter every month, and it's been a good little business to run.
Yeah, no, that's fantastic. It's so good to see that, because I know when my kids did various subjects at high school, economics was one of the ones I thought was really impressive. I think compared to when I went to school, right. I think they've improved it. So that's fantastic. So So back to you then, Brad. So what made you become what I would call an expert in investment strategies and portfolio management? Was this something that you decided when you were 10 years old, or what happened?
Yeah, look, I probably wouldn't go back that far, but I do actually remember when I was primary school age, I guess, my brother had a bit of an interest in the share market, and he had a game called Pole Economy, which I don't know if anyone remembers that, but it was a bit like Monopoly, but it was an Australian version. And instead of buying properties, you bought shares, and it had all the big listed companies on the board. And that was probably my first memory of having an interest in things financial and economic. But through high school, I guess I grew to love economics. It was my favourite subject. And sort of looking back, I think economics provided that sort of balance between a social theoretical concept as well as having quite a strong theoretical and maths discipline. It is essentially a social science, but it sort of brings together a lot of disciplines. And I think that made it really interesting compared to other subjects, which I saw as fairly dry. So I had the passion for economics. I was lucky to have a very enthusiastic economics teacher in the last 2 years of high school as well. And that sort of made me realise that's the area that I wanted to be in. And I guess that focus on economics then led to investment type roles, and that's how it's developed over the years.
Wow. And do you think, 30 years is a long time to, make such a craft of your profession that you have? What keeps you excited about economics and what you do today?
Well, I think it's the ever-evolving and ever-changing nature of it. So there's always a new piece of data out. There's always a new view. There's always new investment products. So no one day is like the day before. There's always something to test, I guess, your intellect and spike your interest. It's certainly not a mundane role.
Yeah. And I think the pandemic taught us that, because one of the things that I think a lot about, or did think a lot about in the pandemic, we're in the middle of it, we're all locked up at home. I remember thinking, I wonder if I'd asked Brad, or any economist for that matter, say 5 years earlier, if I'd painted that picture of a pandemic of all of us locked up at home and couldn't travel and couldn't go to work, wow, it would have been a bleak view, wouldn't it, of from an economic perspective, yet the world copes so well.
Yeah, and I think that's partly understanding human behaviour and the way humans respond to different situations, which is a key part of economics. It's all about behavioural responses. And trying to get an understanding of that.
Yeah, and probably, would I be right in saying, probably the first event in a very long time where many different countries and governments around the world came together on something to get us through? I know they borrowed a lot of money to get us through, but the world seemed to be quite united on getting us through the pandemic, would you say?
I agree with that in a lot of different areas, and even within the context of Australia, having the state governments work with the Commonwealth government, effectively establish a new governance structure through that period. Was quite significant, and from a policy perspective, it was a massive experiment in a lot of ways. And I think that period actually taught us a lot about how economies work, how potentially policy can work better in the future as well.
Yeah, I mean, it certainly gave me some confidence about the future in a way, because I sort of feel if we can get through something like that, we're in better shape than I would have thought we were as a global world. Talking about that, there's a lot of talk at the moment about global recessions potentially in 2024 and 2025. And I was only with a client last week, in fact, and we had a look at their portfolio or their wealth growth, not just their portfolio, their wealth. We looked at 2025 to 2024 to now, basically. And we were looking at the projections we've done versus how they've performed in their overall wealth. And we all couldn't believe really in the room how much wealth had been created in that period of 4 years, given we did have that period of, that pandemic. We've had so many things in the last 4 years, yet the amount of wealth this particular family had created in property and shares was really quite astounding. And I guess, is that the reason we're starting to hear perhaps a lot of talk about a potential global recession in late 24, 25? What's the likelihood of this happening, and how bad might it be? What's your thoughts on that, Brad?
Yeah, look, personally, I don't see necessarily the data that suggests we're heading for a global recession. I mean, recessions in the scheme of things aren't that unusual. So there's always going to be an expectation the next recession isn't too far away. I mean, historically, once every 7 or 8 years is the normal pattern. We fortunately haven't had that in Australia, but globally that's been more the norm. So there's always an expectation that ultimately you are going to have a cyclical downturn that may turn into a recession. But the world, much of the last couple of decades in the post-GFC environment, has been operating on a fairly even keel. And we haven't necessarily seen those really big swings in cycles apart from the COVID experience. So my sense is that from a global perspective, we can continue to travel on for some time in a reasonably sustainable fashion without necessarily hitting recession. Normally there's some sort of excess that will cause a recession, like a sharp burst of inflation that causes a policy response or a big need to withdraw fiscal stimulus. We've largely addressed the immediate inflation problem on a global scale, so that sort of removes one of the threats. So I do see probably a slightly more optimistic outlook than maybe the recession narrative is suggesting.
Yeah, so it's interesting, isn't it? I mean, it feels to me a bit like whether it's governments or central banks, as time progresses, do seem like they're doing a better job at running economics than what would have been done 50 years ago, would you think?
Yeah, I would agree with that. Yeah. I think there's a deeper understanding of the need to manage the financial system in conjunction with the real economy. I think there's a better capability of doing that, and the policy tools can be used in a more fine-tuned sense to try and manage those two aspects.
And how do you feel poor old little Australia's going? We're such a tiny little world. How do you think our economy is looking in Australia?
Yeah, Australia's doing it tough at the moment. We've had 7 out of the last 8 quarters have been negative in terms of economic growth per person, which ultimately means we've had an erosion of living standards over the past 2 years, which is not what you want from an economy. And underlying that has been a fairly significant fall in productivity. It's ultimately productivity in terms of the return we get from each hour of labour that drives living standards. And there's no real sign that productivity is improving in any significant way. It's actually the worst period of productivity we've had since records were kept by the ADS going back into the 1940s. So it's a significant issue. And yeah, we've got a little bit concerned about the outlook for the Australian economy. Our biggest trading partners are also doing it relatively tough in China, so we're not getting the same external stimulus that we have had over the last couple of decades. And perhaps we've become a little bit complacent in the way we're approaching economic management, which is not surprising given we've had 2 decades where we've had this big Chinese stimulus. Things have come relatively easy in terms of economic growth. I think from a policy perspective, we really just need to knuckle down and work out what's going to improve economic efficiency and get onto a better growth trajectory.
Yeah, I mean, it's been interesting on inflation, and Alistair might have something to say on this in a minute because he sees a lot of clients. And what I'd say is often there's a disconnect between the financial data we see and real life, so to speak. But with inflation, that isn't the case. And I'm sure, Alistair, you're seeing a lot of clients coming in talking about how they're finding it hard to live on budgets and needing to increase income. Would that be right?
Yeah, absolutely, Craig. I mean, yeah, cash flow's sort of quite a hot topic when doing client reviews and seeing clients. And obviously, as Brad's been talking about, inflation, we've had, sort of best part of 2 years of rising rates. So that's really impacted on clients' cash flows and their ability in it. And, there are a lot of people worried about their cash flow and sort of, seeing the light at the end of the tunnel and how they're going to get through this period. So, yeah, Brad, what's your sort of thoughts on maybe the next sort of 6 to 12 months with sort of, inflation's generally under control, but we haven't actually started to see rate cuts. It's, in the news a lot. So what's your sort of thoughts on the, next 6 to 12 months with sort of, the cost of living and rates?
Yeah, I think inflation is on a downward trajectory. Yep. It hasn't been as fast in Australia as it has been globally. And our policy response here was a bit slower, so that's maybe not that surprising that it's taken Australia longer. Our interest rates haven't been as high as, say, they have been in the US either.
Yeah.
But I think the general trajectory is still downwards, even though the data has been quite slow to reflect that, largely because demand has been capped, and you have had that constraint on real disposable income, which ultimately softens the demand pressure on prices. So I think we will see inflation track downwards, and will gradually get down to that sort of 3% level where policymakers will be more comfortable, and we will ultimately have an interest rate reduction.
Yeah. And sort of before we move off, sort of general economic outlook, I haven't seen it. Maybe Brad, you'll tell me there's a lot of data about this, but is there much talk yet about the US election and the impacts of that? Are you seeing much of that being discussed yet, or is everyone still trying to work out what the differences are?
Yeah, well, I think that's part of the problem is that there's so many variables when you look at who will win the election, who will win Congress, who will win Senate, what policy changes they'll be able to get through, what policy changes they actually want to make. So there's a huge amount of uncertainty around the outcome. And from experience with a lot of these elections, you can have significant change in power, but not necessarily significant change in policy. So I think it's a matter of sort of waiting back and seeing what happens and making an assessment with a little bit more knowledge. There's a lot of general concern, but no real specific forecast about exactly what the implications for the broader economy and indeed individual companies will be.
Yeah, and I guess it's that uncertainty that markets don't like either, is it?
That's right. And you'd normally say, well, we're this close to the election, perhaps you'd be expecting some pullback in investor sentiment. Surprisingly, we haven't seen much of that, and we had a very sharp correction in early August, and the market immediately recovered. And that correction wasn't necessarily related to the US election, probably had more to do with the Japanese policy tightening. But yeah, look, investor sentiment remains pretty robust. So whether or not that remains right up to the election, only time will tell.
Yeah, I think that volatility in August was yet again another reminder to not only investment professionals like all of us, but to every investor. You just don't know what's going to go wrong. And there were plenty of, well, what's going to change, what markets are going to do. It's just impossible to predict anything in the short term anymore. But moving off sort of that general sort of economic outlook, if we now move into investment fundamentals, and I think this is really good because it doesn't matter how many years you've been investing or how experienced you are. I think people still confuse the role of asset allocation. And I know when I did my master's degree, there was more talk about the importance of asset allocation than a particular investment when it comes to driving risk-adjusted returns. I mean, Brad, you've been an economist now for a long, long time, working in as a professional, helping advisors advise their clients. What would you say about asset allocation?
Yeah, look, I agree that asset allocation is the first and most important decision in determining an investment strategy. I mean, the data clearly shows that someone who holds 100% of their investments in bank deposits over time will have a very different outcome to someone who has a healthy exposure to growth assets, such as equities and property and so on. So getting that balance right is clearly very, very important, and ultimately comes back to the capacity to take risk and the need to take risk in order to determine which is the most appropriate asset allocation. But it is such an important decision, and that the implications of that decision just grow and compound over years if you don't get it right.
Yeah. Which sort of brings me on to market timing, which is another big issue that investors face, advisors face like us. I mean, every day clients sort of want to know that we have this incredible gift to predict the future, which no one has, and we explain that to clients over and over again. And whilst we may have some educated opinions on things, there's absolutely really no way we can predict which way any market's going to go up or down with certainty. So I guess this market timing is something we can't really talk enough about, and there's been many, many studies on market timing, many academic studies. After 30 years, Brad, what would you say about market timing?
Yeah, I think the key point you mentioned there, Craig, is there are no certainties, and that always needs to be front of mind in setting investment strategies, because nothing is certain. And timing the market, predicting when there will be turning points in direction, is very, very, very difficult. I do think, however, there are times where the probability of events changes. So if you think about currency, for example, when the Australian dollar was up at $1.10 US, the probability that the dollar was going to come down back to its more fundamental level was pretty high.
Yeah.
So there are times where you can make adjustments to portfolios to either seek out additional return or manage risks. In situations where markets are clearly overheated or overvalued, probability of a correction is probably higher than it would normally be. So I think there are times when you can not necessarily predict turning points, but maybe take different actions in portfolios to try and manage that balance between risk and return.
Yeah, that's a really good point, because that's probably what we do at Navwealth more than anything else. You know, at the moment we've seen equity portfolios sort of grow as a proportion of the portfolio, particularly for retirees that are taking cash out to live on. So over time, their portfolios are getting more and more aggressive. So Alistair, you would see that a fair bit with the retirees you're working with.
Yeah, absolutely. I think especially when, going back a few years ago when interest rates were so low, it sort of forced people to take on more risk and take on more growth assets, whether they liked it or not. And I think, market timing, asset allocation, having a good mix of assets, both defensive and growth, is very important to, drive return and deliver the income that retirees need. Yeah, well, any sort of further thoughts on that? If you have had growth due to natural market movement, then potentially you are moving away from your risk profile that's been set out and agreed. So some sort of action needs to be taken. And the great thing about that is you're actually locking in a profit if you do that. If your equities have increased to be above weight, you can feel really good about cashing some of those in and taking a bit off the table. That's a bonus,
And it's not easy to do, is it? I mean, we client the other day, we had to break their arm to adjust the portfolio down because it gone from 70% growth to 78%. And we know that if things get sort of volatile again, they won't want to be at 78%. So we spent a lot of time talking to them about, reducing their exposure to equities. And because their returns last year were 12%, they're like, oh, why would I want to change this? This is fantastic. So it's not always easy. Moving on to the next topic, which is sort of emerging trends and technologies. And I say technologies because I don't think we're quite sick of hearing about AI. Artificial intelligence is the buzzword everywhere, no matter where you go, who you talk to. It's the constant thing everyone wants to talk about. And I do think it's interesting as a business owner because we've been dabbling with AI in our business. And whilst it looks incredibly promising and is improving some back office functionality, it's not as simple as just this sort of silver bullet of efficiency. So I think we've got a bit to go there. But when it comes to investing, Brad, what's your thought of AI? Is it too early to talk about? How do you think about investing in AI?
Look, it's certainly not too early to talk about because it makes us such a big component now of the investment universe. When you look at the top 10 or top 7 US stocks in that technology sector, you can't really have a view on the equity market, the global equity market, without having some sort of view on AI. It's such a big feature of what's driven prices over the last couple of years in particular, which makes it quite hard for a lot of investors and a lot of analysts like myself, is having that level of understanding in order to make some sort of determination about the appropriateness of the way the market's treating AI. So it's certainly not too early to have a view. I think where the market has rewarded businesses involved in the value chain has been appropriate because you're actually seeing the productions of chips and semiconductors and so on. Those businesses have been rewarded in a big way. I think where the question mark is still, and this is hardly controversial in saying it, is that we haven't actually seen much in the way of application of AI down at the user level. And that's the big test. Are the applications going to be significant enough in order to justify the huge investment and the huge valuations that have been placed on some of the companies in that value chain? And I do think that there is a risk that we assume that the applications may be a lot easier than they will be in reality. And one thing that comes to mind for me is when you look at traffic lights, for example. We've had technology probably for 20 years that could easily increase the efficiency of the way traffic lights work. When you think of a crossing, you might have 50 people ready to cross a road and there's no cars. You wouldn't think it would take much in the way of AI to actually put a camera on the lights. It's proved too difficult. So I don't think we should assume necessarily that just because the technology's there, that you necessarily have all these end benefits. So I guess I'm a little bit cautious, but I'm not in the camp that suggests the market's gone way over in terms of the way it's treating that thematic at the moment.
And I love your analogy of traffic lights. This morning coming to work, that mucked around with this particular set of traffic lights, and I was there for so long, we all were, that everyone started pipping horns and actually driving through the red light, because it was clearly they've changed something on it.
Right.
I thought it was really interesting to watch how many people were game enough to go through the red light, knowing they could see what was coming. Same thing as what you're talking about. I'm sitting there thinking, this is ridiculous.
You're not publicly disclosing you broke the law today, though, are you?
No, I didn't, Brad. I didn't go through the red light. I was too scared. So I was getting lots and lots of bips and craziness to break the light, to break the red light. But yeah, sort of. That's what I'm seeing. I mean, we've all read the articles that 30% of jobs could go out of banks, for example, because of technology, and I can sort of see that. I mean, I think about when ATMs came in. I'm sure, I don't know what the percentage was when they lost all the people in the branches that we used to go to, and now we go to the ATM. So I could see a large proportion of displacement of people, but I also can see the AI won't run itself. So there'll be a whole bunch of new jobs that come along. So it's going to be interesting the next 10 years, that's for sure.
Yeah, I think we've seen that cycle many times over in terms of what technology does for efficiency and changes the way we work, and this will probably be no different.
Yeah, and I guess for investors, it's all easy once the horse is bolted in hindsight to look back and go, oh, I should have bought that semiconductor stock, or I should have bought whatever stock, doesn't matter. But it's actually really difficult, and whenever I've seen really good clients of ours that really good investors, I should say, that are clients of ours that manage a proportion of their own stocks, who stock select. I mean, most of the time they get it wrong. I mean, they buy 10 stocks thinking every one of them is going to make them a fortune. And it's often 1 in 10 do and 9 don't. And it's just not that easy, is it?
Yeah,
choosing these stocks.
Which is why we have professional fund managers doing that for us, I guess.
Yeah, which is obviously our preference, to use that combination of index managers and active managers, and using the active managers to add that extra value, or alpha as we call it. And that's why we have you, Brad, to help us choose those active managers. We have very rigorous debates in our investment committee.
That's right.
With Brad. And talking about that and future trends, the last thing I wanted to bring up, I thought, was what you might consider, outside of AI for a moment, some emerging trends.
Yeah, look, it's a good question. I do think maybe one area that has been forgotten a little bit is the impact of continual improvements in technology, including AI, on the healthcare sector. There's a lot of application that we're seeing in some of the technology advancements around diagnosis and treatment. So I think that's an area ripe for further development. And hopefully it's an area where Australia can be a bit more involved in than it is at the moment in some of these areas of technology. There's a lot of good Australian medical and biotech businesses. So that's an area that I would look to be fairly optimistic about and excited, both from an investment perspective, but I guess the older you get, the more you care about healthcare as well.
Yeah, it's interesting, healthcare, because I remember maybe 10 years ago now, it was the real topic of the day, like AI is now, around how can healthcare not be an industry to invest in, given we've got an aging population, the demand's going to be huge, there's a lot of new private entrants coming in, like Ramsay Healthcare. So it was sort of 10 years ago, a bit like AI now, it was a bit of a certainty. People thought it was a certainty that healthcare stocks were going to do really well, but we've seen recently with Ramsay how it's not as simple as that.
Yeah, and it just shows you just can't pick a company because it's in a sector that you like and expect it to go well. And I think Ramsay is actually a good example, because one of the reasons Ramsay perhaps hasn't met expectations is because there are fewer surgeries now. The medical treatment has improved, where there's more day surgeries, less overnight need for overnight stays, which affects the revenue of Ramsay. So it's a good example of where you actually need to understand the company as well as the broader industry and thematic.
Yeah, which is another example why for our clients and our portfolio constructions, we prefer index with active management where it needs to be active. And we say to our clients, go and play golf, go on your boat, go and travel and enjoy your life, rather than trying to select stocks. So moving on, we thought we might sort of close, or not quite close, but talk a bit about sort of practical advice for listeners. And what we mean by that is, in our client base, we obviously have, we've been around for 33 years, so we have everyone from retirees right through to now second and third generation of clients. So I thought I'd ask Alistair, given he's a little bit younger than me, what do you think are the practical lessons people need, Alistair, particularly for the people now in their early 30s, unlike me in my mid-50s nearly? What do you think are some of the practical tips we need to help young people with?
Yeah, thanks, Craig. I think for the younger generation, I think it's just getting understanding of, what their objectives are and starting on that investment journey. I think, especially in Sydney, we often see too many younger people go, oh, it's just too expensive, I can't afford it, therefore I won't do it. But I think, as we've seen, investing over a long period of time really does pay benefits. And I think, talking about the sort of the time value of money and the compound effect of investing over a long period of time is obviously a really important strategy that the younger generation really need to sort of consider and understand. Because, when you do come to retire, if you've been doing it for 30, 40, 50 years, that sort of wealth creation and building wealth over that time is really going to be of benefit.
And what about any common pitfalls you see, sort of without dobbing your friends in? Any common pitfalls you see?
Yeah, I think typically what I see is a lot of people live in the here and the now and sort of spend their money now and do all the things which, there's an element of truth to that. But, a lot of people, probably the younger generation, don't necessarily think ahead and think about the future and where they might want to be in 10 or 15 years' time. And I think, trying to sort of put some money away and invest and think about the long term and where you want to be from a sort of wealth creation point of view is quite important. I think that's probably one of the biggest pitfalls I see, is just too many people, think the here and the now today, need to go and buy that and need to spend that money here and not necessarily are thinking about their future.
Yeah, the old have a plan. And it's hard enough sometimes for people in their 50s to get their plan. Some people in their 50s are getting their first plan for about their life, when really it should be starting many, many, many years before that. Yeah. Brad, any thoughts from you in terms of, you're talking to all these high school students in some way, shape or form. What do you think are some tips? I've just thought about that for all the readers.
Yeah, I can't really talk to them about investing as such. It's more on the macroeconomics. But yeah, look, I think one of the pitfalls, and this would go for investors as well as financial planners, is around recency of performance and directing investments towards those strategies and funds that have performed well in recent periods. And it's very hard not to do that. And I think that's a discipline that has to be learned through an investment process, is understanding why something has performed and understanding that it's not necessarily repeatable. And I guess part of my role is to work out what parts of an investment and what parts of a process actually lead to a repeatable process that's going to generate appropriate returns. But it is extremely tempting to think that just because a fund has done well over recent times, that will be repeated in future.
Yeah. In fact, maybe better off to choose the worst performing sector and fund last year.
In a lot of ways, there could be some truth to that, but there's also some very ordinary product out there that you need to be very cautious. So.
Yeah, and I think that's why we have Brad on our investment committee. Brad brings some independence to our thinking, so that at Navwealth we don't all end up just agreeing with each other. That's the robust discussion that I like to have when Brad comes along for our investment committee. So I guess for some final thoughts, we might wrap up there. It's been a really great listening to both of you and your views on these topics. So I guess just to wrap up, what's the one piece of advice you would give our listeners who are looking to navigate the complex world of investment strategies and portfolios? Maybe we might start with Brad, given he's our special guest.
Yeah, Craig, I think one piece of advice would be to never stop asking questions about your investments. And even if you don't want to get down into the individual details of companies within a portfolio, I think there's still a need and also a responsibility on investors to have an understanding of their investment strategy. And what they don't understand, continue to ask an expert until you do get that level of understanding. And it's only when you have that level of understanding that you can really feel satisfied that you actually have the right strategy in place.
Awesome. That's a fantastic idea. What about you, Alistair?
Yeah, I think just to sort of echo Brad's thoughts is there's so much information and so much data out there on different types of investments and different types of strategies. I think, just getting some professional advice. No one can be an expert on everything out there. Come and see us, come and get, see an advisor, get advice, ask questions, do your research. So important.
Yeah, I agree. I mean, we have this catchphrase at Navwealth called destination on purpose. And what we mean by that is we want our clients to get to their destination, whatever that is, it's whatever their destination is, and get there on purpose. We see a lot of people become or reach financial freedom by accident. In fact, if you did I'm pretty sure the numbers for Australia would be by accident. In other words, if there was no inheritances, the number of people that would reach financial freedom and security would be considerably lower. So for a lot of people, they really do get there by accident. What we try to do at Navwealth is help clients with a plan to get where they want to go, so they get there on purpose. And when the inheritance comes along, that's great, but that's not the reason they become financially secure or reach financial freedom. And the last thing I would say on that is, we see most clients come to Navwealth at around about age 50. Most of them have successful careers or businesses, have accumulated some wealth, but are quite willing to sit in front of us and say, guys, we don't actually have a plan for the next 20 or 30 years of our life, and that's why we're here. And I think for a couple particularly that have maybe different ideas on their future, that is just so valuable to sit down with the likes of Alistair and other people here at Navwealth and talk about their future. There's just, tonight we have some people coming in that are specialist doctors, very busy people, very smart people, and they're coming in to see Alistair tonight to talk about their future. And I think that's the value of seeking advice from a firm like Navwealth. So thank you very much, Brad, for coming along today.
Pleasure.
I really appreciate your insights, and it's great that you can sort of let our clients know a bit about what goes on behind the scenes at Navwealth. Thank you, Alistair, for joining us.
Thanks for having me.
I'm sure everyone will get a lot of value out of this NavTalk. And so that's it for us. Thank you for listening, and feel free to pass this on to friends and families. Goodbye.
Thank you for listening to NavTalk. If you'd like to catch up on other episodes from this series or previous, head to our Navwealth website. Until next time.